Okay, hello and welcome to MSDynamicsWorld.com's Fall Inventory Management webcast series. I'm Jason Gumpert from MSDynamicsWorld.com, and I am really happy to have you all here with us today. We are fortunate to be joined by Bill Macbeth, Chief Research Officer at Chainlink Research. Chainlink is a widely respected research and advisory firm focusing on supply chain topics. We invite you to add your feedback and ask questions today throughout Bill's presentation. There are a couple ways for you to do this. First, you can use the Q&A block that you should see to the right, on the right side of the window, where you can ask your questions, and we will have Bill leave some time at the end to answer those. Also, feel free to tweet your thoughts. We're going to use the hashtag MSDWinventory to note what's being talked about, and also to take your questions if you feel like it. And we'll be sure, like I said, to leave some time at the end. So without further delay, please allow me to welcome Bill Macbeth.
Thanks, Jason. It's great to be here. It's a very important topic. As a firm that focuses on supply chain management and researching that, inventory management is pretty central to a lot of what we do. And what I'm going to cover today is talk about what I call inventory's multiple personalities. You'll see what I mean in a second, and why we need a holistic approach to managing inventory and what that means, and we'll wrap up with some strategies for success. So you might say, look, inventory is a collection of inanimate objects. How can it have multiple personalities? You know, the answer is it's in the eye of the beholder. So if you think about to sales, this is an absolutely necessary ingredient. Without inventory, there's no sale, there's no commission, there's no bonus. That's why we see chronic over-forecasting from sales as an issue. Your finance guy or gal, they'd be happy if we had no inventory at all, but they know it's a necessary evil, so whatever we have, let's not hold on to it. Sell it as quickly as possible and pay for it as late as possible. The manufacturing person, their job is, hey, this is we transform this raw inventory into finished goods. I want to get just the right amount and just the right time, and I know that those salespeople always have the wrong forecast, so I'm going to make my own. To the supply chain person, it's really this puzzle of balancing supply and demand. To the buyer, just tell me how much, I'll buy it at the lowest cost. To the supplier, this is their bread and butter. If they don't have inventory to sell, there's no business. To the customer, it really depends. It might be just a commodity item that they can get from the next guy, or it might be something that's really critical to their business, and if you can't supply to them, their production line stops or their operation stops. In that case, you better have what they want when they need it, or there's going to be problems, big problems for you. The logistics person, their whole perspective is, how can I move this stuff at the lowest cost? They want to know how big it is, how heavy it is, does it need special handling? The 3PL looks at this inventory. That's really their opportunity to make money by telling you, we can manage this better than you can. And the executive team, this is just one of the pieces, the means to a strategic end for them, the levers that they have to achieve their goals of market share, customer sat, whatever those goals are. So this is why I call it multiple personalities. And what ends up is, it's not that there's one right or wrong picture, but there is a tug of war between these different positions and trying to figure out what's the right way to manage inventory. And just using a simple replenishment formula it's not enough. You need those for sure, but you need a more holistic approach towards managing inventory. So that's really what I'm going to focus on today, looking at how your industry characteristics impact your inventory management strategy, your business model, trading partner relationships, the product characteristics, risk visibility, and strategic alignment. So let's dive right in. Now, industry, if you think about what industry you're in, it's actually more important your position within the industry and what you're trying to optimize within your company. So let me give us an example. Within the semiconductor industry, you have these foundries, and basically they build these big, they call them fabs, they fabricate chips. They actually fabricate the center of the chip called the die. These factories cost anywhere from $2 to $5 billion to build a single factory. So it's extremely capital intensive, and as you can imagine, these companies, their whole focus is on making sure that that is utilized as best as they can and get a good return on that asset. Now, in contrast, the fabless design companies, these are a bunch of engineers designing chips, and they hire these foundries to make the chips for them. Their whole focus is on the product and time to getting a product to market that's better than the next guy quickly. Then you've got this third type of company, which is assembly and test companies. What they do is they take that die that the foundry made and they package it up into a particular type of package for a particular application. Their factories are much less expensive, and their whole focus is on providing that postponement until you know what the actual demand is, and so it's really about agility. And so if you look at this, it's these optimization objectives, the different optimization objectives really have a huge impact on a company's inventory strategy, and very important to understand that. Now, the fact that you have 3 different companies in the semiconductor sector just making the chips, that is actually a somewhat new development. And that leads me to my next subject, which is how this business model has evolved and the supply chain structure has evolved and how that impacts inventory management strategies. So if you turn the clock back to, say, the 70s and the 80s and even the early 90s, you look at, say, an IBM or an HP, they made their own chips, they made their own storage devices, they wrote their own operating systems, did their own service and repair. Everything was done within the 4 walls. That has transitioned. We've all seen this move to outsourcing, and initially the outsourcing was just, you take care of the problem for me, but people have realized that they really need to have a more active management. We call it the federated model or the orchestrated model. So there's been a transition in how those things work, and it has also transitioned what's important about managing inventory within those various models. So to get a little more specific, when we talk about a business model and what the differences between these models are, a lot of it has to do with when does ownership change hands as goods are flowing through, and who has the responsibility for making the decisions about replenishment and how much inventory we're going to carry and where we're going to carry it. So that really should depend to a large extent on competencies. You think about forecasting. The manufacturer, it's well known that they almost always have much better knowledge about causal factors than the retailer. It's impossible for the retailer to know about hundreds of thousands of products the way a manufacturer does. On the other hand, the retailer has the demand data. They know exactly what's been consumed at the point of sale information. So here's a case where you want to get the best forecast possible. Bring these 2 things together and get a better forecast. So the other thing is who decides what your replenishment policy should be and how much to hold and where to hold, all the way from the store all the way back to the manufacturer. Those are the different business models, different types of business models, and a lot of time those things are mandated by the power players. So if you're a Walmart or if you're a Dell, you're going to tell your suppliers, this is how we do business. If you want to do business with us, this is the way it's done. So I'm going to give an example or a couple examples here to really drive home what this business model means for inventory. And I'm going to focus the next few slides on the transition that high-tech went through from a build-to-stock to a build-to-order model and a VMI model. So I'll talk more about that in a second. But we have similar things in CPG, retail. They've actually been doing VMI a bit longer than the high-tech folks have in general. And that could be the supplier might be managing to the DC or actually all the way to the store. And the kind of extreme version, now this has more to do with when title passes, is the scan-based trading, where it's really a consignment model entirely all the way through to the cash register. And the CPG company owns that until it's actually bought by a customer. So let's look a little bit at VMI. We were privileged to run a working group for the Electronic Supply Chain Association. This was quite a few years back, but it was when the high-tech industry was going through this transition. The old model was a build-to-stock model. The new model was build-to-order with using a VMI hub. So what does that mean? And if you look at the traditional model, so the customer's plant, so this would be, again, a IBM or an HP or someone like that, they would have a buffer stock, a safety stock for their production, sitting right in their plant based on the lead times of the supplier. And when that got below a certain level, they'd send an order to get more. So they owned that inventory, they managed it, they make all the decisions. In the new model, and it may not be quite obvious from this picture, but this production buffer stock is not actually sitting right in the customer's plant. It's usually sitting in a VMI hub that's usually like right across the street or nearby, very close to the plant. And now that inventory is owned by the supplier until it's ready to be consumed in the plant. And the supplier also has the responsibility for managing that inventory and making sure that they have it whenever it's needed. So this actually was a huge change in the industry and very painful for a lot of suppliers. One of the changes, of course, what I just mentioned, what is the amount of time from the time the customer or the manufacturer places an order until I receive that order? It used to be weeks. And now, like Dell, when they started doing this, said, look, we go into this model, and when I place an order, it has to be here within 2 hours, and then they reduce it to 1 hour. So the only way those types of requirements is to keep inventory nearby, in stock, all built and all ready to go at a nearby location. Now the other thing is, the other question, and the thing that changed a lot, was when you get paid, when the supplier gets paid. So, in the old model, they'd get paid in steps 1 or 2 here, either when they shipped it or when it was received by the customer. In the new model, we find that the most common places is to get paid when it gets pulled out of the hub or when it gets received by the customer at their facility, which is it's going to be the same day, so it's virtually almost the same. Some customers even say, we're not paying you until it actually goes into a kit or gets manufactured. Now, this is another really big change and shows you how significant these business models can be to cash flow and inventory. So what it did was extended the supplier's cash-to-cash cycle by 2 to 3 weeks. So they have to wait another 2 to 3 weeks on average before they get their money. That's why this was such a painful change for that industry. So as part of this study, when we were leading the working group, we also did research of about 100 companies to try to understand what's the impact of this new model compared to the old model. What happens when you change business models like that? Who gets helped and who gets hurt? And probably the bigger question is it helping the industry overall? And I'll get back to that question in a second. Now, this chart can be a little tricky to read, so let me explain it for a second. First of all, the blue bar are what the customers, so that would be, in this case, the OEM manufacturers, the HPs, Dells, and Ciscos of the world. What was their answer? And then the purplish bar here is the suppliers, so that would be the disk drive and the memory manufacturers, etc. And higher means that the impact of going to VMI was positive, and lower means the impact was negative. So the yellow line here at the number 3 in the middle, that's neutral. It means basically no change. That's how you read it. The place that gets a bit tricky is if you have something that is a cost or a liability like inventory levels, then the higher the bar, the lower the costs, because it's a positive for you to carry less inventory. So that's how you read it, and let's just see what some of these changes are. The most obvious one, no surprise here, customers' inventory level, that was a big positive. Their inventory went down, and for suppliers, their inventory went up. In terms of service levels and lead times, they both said that those improved dramatically. Now, keep in mind, this does nothing to change the amount of time it takes for the supplier to manufacture the item. So it's not the manufacturing lead time, it's just the replenishment lead time, which is accomplished by holding inventory right next to customer's site. We also asked about flexibility and liability. The customer's flexibility has more flexibility under this arrangement, but the supplier, if you think about it, they used to keep all their inventory pooled near their own plant, and they could send it to where the demand was. Now it's fragmented into these locations near the customer's plant. It's a lot harder to move that around to where it's needed, so they have a lot less flexibility in this arrangement. Now, if you look at, we also looked at various costs like transportation costs, administrative, technology, and manufacturing, and how this impacts that. And essentially, for the customer, these costs are more or less flat, except for technology. They actually incurred additional costs for technology to manage the VMI relationship. For the supplier, their manufacturing cost doesn't change, but all the others are additional costs. They have more transportation costs, more admin, and more technology costs. So additional costs across the board for the supplier. It's not all a negative story for the supplier. We asked these 4 questions only really applied to the supplier, but they felt that under VMI, they were getting more revenue, they had better visibility to demand, they improved their order to delivery time, and they had higher customer loyalty. So even though it's very painful for them from a financial point of view in terms of the cash-to-cash cycle, there was some benefits here. This type of business model, they felt they were much more embedded with their customers, and therefore had more loyalty. So back to my original question, when you change a model like this, is it good or bad across the supply chain? Are we holding less inventory net between the supplier and the manufacturer to meet the same service levels? And I'm going to disappoint you a little bit here by saying this is something we were not able to determine by asking these kinds of questions. The type of data you need to do this was really not available from the customers that we spoke. However, anecdotally, it does seem like there were improvements in those cases where there was really a collaborative relationship between the supplier and the manufacturer or the customer. That brings me to the next area, which is trading partner relationships, a very important piece of the overall picture of managing these types of relationships, these types of inventory. So you can look at these trading partner relationships as the human part, the systems, and the contract. As we just discussed, the collaborative relationship is much more likely to succeed, and of course there are technology and process pieces of that, but perhaps one of the most important pieces is the human relationship. If you can't establish that trust, it's really hard to collaborate. I remember one time I asked a fellow, we do a lot of research, we ask a lot of questions, and I asked someone, is it better when should you trust your supplier, and when should you withhold information from them because you don't trust them? And his answer was never and never. So the point was that withholding information is not a great strategy, but on the other hand, you really need to have something in place to make sure that your partner is doing their job. So this whole set of processes and systems that link us up, this is how I buy and how you sell, or how I order and how you fulfill, and those kinds of things. That can have a huge impact on the effectiveness of our inventory strategies, and especially the linkages between the systems that can provide visibility or not, and help to automate some of these things. So it's another very important part, and especially when you're going through a big change like this VMI change was, it's a good time to really revisit all of the ways that you work with your trading partners to say, are we really doing this in the best possible way? As far as the contract is concerned, so the goal here, of course, is to say, here's what our relationship is going to look like. And it serves a purpose. The most important purpose is not, if things go wrong, who's going to sue who. It's really that it forces the parties to think about the relationship clearly because they're making a commitment, and put that down in writing and make sure we're all on the same page. Now, I want to talk to you briefly about structured contracts, because I think they're a very valuable tool in managing inventory to make sure that the buyer is communicating the expected range of demand and that the supplier is putting a price on that flexibility. So here's an example, and essentially this divides. Let me back up one step here. What you need to do is do a range forecast. A typical forecast says I'm going to consume 100. A range forecast said I'm going to consume between 80 and 120 or 125, whatever those numbers are. And the range needs to be based on your confidence in demand and the volatility of demand and the accuracy of your forecast. That's how you're going to determine how big that range should be, and it's something you can calculate very precisely using the right tools to know what the range should be. So given that you've got that range, now if you look over on the left here, on the lower left under buyer's liability, what's happened now is the buyer says on the lowest end of that range, I am extremely certain I'm going to consume that demand. So I'm going to give you a much longer term commitment, but I want a break for that. I want a big price break for that. So you tell me, if I give you this commitment over the next year, the next 4 quarters to buy this many units, what's the price that you're going to give me in exchange for that commitment? Because it gives you a base level, you the supplier. The next level here is, that's the sort of medium or expected demand, and that's kind of the normal terms, the 6-week lead time. Here's how many I expect, what's my price there. And then the up one is, if things really go crazy and take off on the high end of my forecast, this is how high I think it could get. How much will you charge me for that, with, of course, a shorter lead time? So this is an excellent tool for communicating that level of uncertainty and then putting a price on the flexibility. And also, there needs to be penalties and liabilities in there so that either side is held, feet is held to the fire for keeping their part of the bargain, so to speak. Okay, so that's structured contracts. Let's move on now to how the characteristics of your product and the market you sell into also impact your inventory strategy, and what are some of the things you can do. So I'll start with, this has to be designed into a product, this idea of configurability to support postponement of differentiation. So that's a concept. If those of you who are in the supply chain field, I'm sure, are most likely familiar with deferred differentiation or postponement. This is the idea, let's say I'm selling into different markets that require either different languages or packages or colors, that the basic core product is the same, but I can wait until the last minute till I really understand to differentiate the product into those different languages or options and combinations. That has to be designed into the product. If you don't have that product characteristic, you're stuck with a very splintered demand. How forecastable is the product? Is it something that's impossible to predict? How many SKUs do you have? Where does it fit in this unique to scarce commodity spectrum? These are all things that will impact your inventory strategy. So let's say that you have high-end fashion dress. The strategy may be, we're going to have one of each size in the store, and that is it. Make people really look at this as a very exclusive item. Something like paper towels, that's not what you want to do, right? You want to just make sure they're always in stock, because if the shopper sees they're not there, then they're just going to buy another brand or go to another store. So I also want to talk about 3 more areas here within the product area, and that is, one is the product life cycle and how long it is compared to the replenishment times. The second is doing product transitions, which are really critical and one of the most difficult things in terms of inventory management. And then the third is carrying costs. So we're just going to do a little drill down on those 3. Now, the product life cycle, this way that I'm showing here of categorizing products has to do with the ratio of the lead time. So this is the amount of time it takes from when you, the customer, place an order until it's received at your door. What's the ratio of that to the entire life of the product from the time it is launched until it's retired? If it takes longer to get that product than the entire life of the product, we call it a one-time buy, because you have to figure out how many you need to buy before you've sold a single one, and buy it all in one shot, and then start doing your prayers, and hope you got it right. The short life is slightly better than that, because in this case you can do a buy that is not the full buy, and start to sell a few of them, enough so that you can get an understanding of how hot is this item going to be or not, and then order the rest of them, usually in one more shot. And replenishment is more typical, like a paper towel might have a product life of several years, and a replenishment a lead time of, say, 6 weeks or something. So you're just going through this continual cycle of trying to see is demand going up or down. So the real challenge here is this one-time buy, because you're basically trying to, without having seen any actual market demand, you're trying to forecast exactly how much and basically commit to buying it. So one of the approaches here is to try to move yourself from that one-time buy to a short life. And you're not going to change the life cycle of your product and make it longer, because the world moves on, right? If it's fast fashion, or if it's a phone or something, it's got a life, and then after that, nobody wants it. So the thing you can work on is to try how to shorten that lead time if it's longer than the life of your product. I want to give an example that I think might be instructive. A sunglass manufacturer, and they were having a heck of a time because they would have maybe half a dozen different models for the next season, that next summer, and they had to order all of them before the season started because the lead time was too long with their suppliers. And they always guessed wrong. They would have extras of the model that wasn't doing so well, and they'd run out of the one that everybody loved. So what they did is they worked with their supplier and said, look, we have a pretty good idea how many we're going to buy total. So we're going to place a firm order for that amount earlier in the year, and you go start buying the raw materials. And we're also going to place a firm order for a smaller amount of each model. And then that way they would build those, they'd have all the materials in place, they'd get to sell a few of them and start to see what's popular or not. And they basically did a much better job. They turned themselves from a one-time buy to a short life. Now you can't always do that, so what are some other options if you are in this situation where you got to place your whole bet at once before you've seen any demand whatsoever? And the traditional way is to look at what its predecessor did. So if it's just a line extension, it's not as difficult. If it's a truly new product, it's a lot harder. You still try to find what's a product or a set of products that are just as close, how well did they do, and adjust for all these differences I've got listed here. But I wanted to talk more about, that's the traditional way, about some of the newer things that have come along that can help not only with the one-time buying, but really with some other cases where you're trying to read the mind of customer. I actually just wrote an article called ESP for the retailer, and talked about a few of these things. So one of them is this idea of the consumer games. There's a company, First Insights, out there, and that does some of these. And what it is you actually have a whole bunch of your target customers to go in and play these games, which is, what price should this thing cost, or what style do you like, or do you think others will like? And these turned out to be pretty darn good predictors that really are a lot better than maybe your own guesses were. There's a bunch of companies out there that will monitor social media, looking for trends and stuff like that. And this third one here is sort of the low-tech approach. Some of these fashion stores, they'll hire store associates, of course, that can really relate to the demographic they're selling to. But more important, besides them hobnobbing and understanding what's going on with the customer base, they've empowered them to go back to the merchandising and buying organization. In fact, they encourage them to tell us, what are you hearing? What's the word on the street? What fashions are hot and what's not? So this is another way to really get into the mind of the market in a way when you have to make these kind of big bets. And that's going to really help you to not get stuck with a bunch of inventory that you got to sell at markdown, or run out of inventory because it was much more popular than you expected. Now let's talk for a minute about the transition, the product transition when you're bringing a new product in. This is one of the most difficult things to do, to try to figure out when is that new product going to be ready. When should I stop buying the old product? How much of the old product inventory do I need to hold to get me through? But once that new product is there, you want to have, the ideal is you exactly sold the last one, and now the new product is ready on the same day, right? It never works out just that way. But you don't want to get stuck with a whole bunch of that old product which is now obsolete, or just maybe even worse is have this gap. You ran out of the old one, and now people are waiting and going to your competition because they can't get anything from you. So this was a strategy that I think is really quite good one by a major semiconductor manufacturer, a very large one, and their product launches, they had tens of millions of dollars on the line, maybe even hundreds of millions in some cases, when they launched a new product. So what their team would do, first of all, they'd say, what are all the things that can go wrong? Let's brainstorm and get in a room. You know, engineering schedules could slip. A supplier can't wrap up their production fast enough to meet demand if this thing really takes off. Or a competitor comes along and introduces their product before us at a lower price and really, you know, cuts undercuts our demand, and demand will be much lower than we expected, so forth and so on. They go through and develop a set of likely or feasible scenarios. They're not going to go through the wild ones. But for each one of those scenarios, what are we going to do? What will our plan be? What's the best plan of action? And also for each of those scenarios, what are the key indicators that say, hey, you know, it looks like scenario B is about to happen. You know, what are we going to do? And they put all that together into a dashboard that monitors those indicators. And now in real time, as they're going through that product transition, they can see, hey, this looks like scenario C. Let's spring into action. We've already got a plan. We know what we're going to do. And this approach, I think, is a lot better than the sort of seat of the pants. Now what do? We just noticed this is happening, and so forth. Obviously, that level of diligence is going to depend on the importance of the product and how many products you've got to do. So maybe you've got a much abbreviated version of this, or if it's not that important a product, it's, you know, you don't do it at all. But this, I think, can help a lot in transition planning. One of the most difficult parts of inventory management. I'm going to talk about total cost sourcing, and you say, what does sourcing have to do with inventory management? Well, this is just a concept that can be borrowed from the sourcing folks and used to help figure out where I should be holding inventory and how much. So the idea behind total cost sourcing is instead of just saying who's got the cheapest price, you want to look at the total cost, including the transportation and total landed costs, and things like if vendor A has better quality than vendor B, you know, what is that costing me for that poorer quality? Or if I have to hold more inventory because the lead time's longer, what's that costing me? You know, and then I'll add all this up and make a decision what's the best choice. You can take the same approach with managing inventory and figure out not just the carrying costs, which are very important, but what are all those other impacts across the enterprise, and what's the cost going to be for me of, you know, not having enough? What's the cost in sales and so forth? And so this is one way to help resolve that tug-of-war I talked about earlier, is to really try to put it in financial terms in making these decisions. Now this list, of course, is much too long, so you've got to focus, you know, figure out which of those factors is the important cost elements that you should be tracking. And this really depends on what industry you're in and what product what you're talking about. So for example, and now I'm back to the sourcing example, but transportation costs in semiconductors as a percent of the product cost is insignificant. I'm going to throw these things on an airplane and get them there. You're not, I have yet to see anyone throw iron ore on an airplane to get it to the smelter, right? That, your transportation cost, is a huge percentage of your total cost, and so you really are paying attention to it. And kind of the flip side would be something like what's the cost of insurance or security because of the risk of theft or damage. And there, you know, I haven't seen too many people stealing rail cars of iron ore, but semiconductors, you bet you're going to have to protect those. And something like the cost of transport time. So traditional apparel, I can put that on a slow boat from China. Fast fashion, not so much. I may want to locate the factory, you know, in across the border there, so I can get it by truck in 1 or 2 days. Difference, even though it's going to cost me more for the item, but that the cost of the delay in getting it is worth more to me than the additional cost. So those are the kinds of things that we can do when trying to figure out where to position inventory and how much to put, and see its impact across the whole organization. Risk management. This is an area that people tend to think about, separately from inventory management, but there's a close interrelation here. So we'll start with safety stocks. Safety stocks, we think of them as a means to make, first of all, to buffer the lead time from our supplier and to make sure that we've got enough to supply, whether it's our factory or our store or whatever. And so we use lead time and forecast accuracy, et cetera, in our standard formula. Excuse me. So one of the things that's not necessarily considered but really should be is what are the consequences of an out of stock? If I've got an item feeding in my factory, then it could be that if I run out, then I just need to produce something else for a couple of weeks till I get that. Or it could be that my factory is shut down without that item. If it's the latter case, I want to know this is going to cost me $1 million an hour. Excuse me for 1 second here. So I want to know, hey, this is going to cost me $1 million an hour if I run out of this. You're going to have a very different approach towards what's the right safety stock level based on that. The other thing, though, is that if you look at these formulas, there's an assumption that the supplier is going to be there and they're going to be able to supply in their sort of normal lead times. That assumption is not always the case. Your supplier could go out of business. Your supplier could be unable to deliver. And you want to know, is that risk high? Is it low? What are my alternatives? Can I fulfill from someone else? Do I have alternative sources? All those things really should be considered when you're trying to figure out what's the right level of safety stock. And you also want a system in place to let you know when something's going south. Now, this could be as simple as the tactical stuff, like this shipment is going to be late. So what am I going to do? Do I have inventory somewhere else to make up for it, et cetera? All the way to, hey, there was a tsunami, my supplier's factory is destroyed, or the supplier is about to go bankrupt. And so these are also important parts of risk management, but they feed into inventory management as well. Sometimes a risk mitigation strategy also has an impact on the what you do with your inventory. So a good example is parts rationalization. You've told your engineers, hey, let's make standardized parts across our products, so we're not using a different one for different gear here for each one of those, whatever it is. That has a great impact, a positive impact towards your inventory management as well. You can now pool inventory across a lot more products and hold less inventory to get the same service level. So there is this important relationship between risk management and inventory management. Visibility and technology, these are really important, incredibly important. So starting with visibility, can you see across your supply chain all the inventory on one system to know what you got where? And this might be a typical view, which I call the islands of visibility. Starting on the left there, you've got a procurement system which has visibility into what's been ordered and when it's expected to come. And you have your transportation management system has the visibility into what's being shipped. Your WMS has visibility into what's in the DC. And by the way, a lot of companies have a separate DC for e-commerce and perhaps a separate WMS system for that, maybe or maybe not. They also have, almost certainly for the e-commerce, is being sent by parcel, and that system is being run by a FedEx or a UPS to track that stuff. Your TMS may or may not know what's in that other system. And finally, at your store here, you've got your replenishment systems, and they've got visibility. They'll tell the store associate what's in my store, do I have it here or not, but they're not necessarily going to tell the store associate what's in the rest of the network or in other stores. One way to solve this problem, and I'm not saying it's the only way, but there are cloud-based WMS systems out there now that can do things like manage inventory at each of these places, including at the store and managing replenishment to the shelves in the store, and also have the mechanisms to input information from transportation and order systems and other systems and the parcel systems to give you this whole picture across the network. And this is an incredibly important foundation for doing a better job of managing inventory, not in many dimensions, like, say, order promising. That customer walks in and you don't have it at that store. Can you tell them, oh, I've got it across town and we can get it to you tomorrow, or I've got it at this other DC? Not without that visibility. You also makes it very difficult to collaborate with your trading partners if you can't have that end-to-end visibility. Another area that technology can help a lot is in forecast accuracy and helping with algorithms and tools for collaborating. Also, now this next one is more about you already have something in place to calculate inventory replenishment points. What's the accuracy of the inputs? So the place where people often fall down, let me back up one step. The formulas often use lead times as an input, as well as forecast accuracy and other things. And a lot of time, people just say, it's too much work to figure out the lead times for everything. Let's just put in 2 weeks for everything. Now, the problem with that, if you don't have the real lead time, then you've just crippled your ability to do a better job of managing your inventory. These inventory optimization tools are great, especially if you have a multi-tier distribution, say a central DC, regional DCs, and then out to the stores, and figuring out what's the right amount and where to put the stuff. And this concept of demand signal repository, that becomes very important in the collaboration or the multi-tier, especially if you're a manufacturer, say to retail, you're getting forecast and demand data and inventory from multiple retails. How can you integrate that all together to make an intelligent plan? So technology is important, and putting it all together, what are we trying to achieve here is a set of strategic goals that our CEO and their team have set for the company. Now, if you look at each of these, internal and external across your sales, your operations, and externally with your partners, there's a set of metrics in place and a set of financial incentives. And the question is, are those aligned to achieve your strategic goals? So the example we gave earlier about the salespeople chronically over forecasting, why do they do that? Because their incentive is they get a commission and a bonus based entirely on revenue. And so they're going to sell as much as they can. And if you start to make part of the compensation based on forecast accuracy, you will see a change in behavior, which might be more balanced, and you might get more accurate forecasts. That's just one tiny example, and across the spectrum here, it's very important to review your metrics and incentives, make sure they're balanced, and make sure they're aligned to the strategic goals of the company. So to wrap it all up here, let's talk about what some companies are doing to be successful. First thing is to realize you set these systems in place, you set these processes and relationships, all the things I'm talking about. The world changes, and the world's changing more and more every day. So successful companies are constantly reevaluating, yes, we did it that way yesterday, but is it the right thing for today? They also manage this tug-of-war in a smart way. So that I talked about at the beginning, right? Instead of letting one party be the bully, and a lot of time that might be sales, but it might not be. It might be someone else, finance or whoever. They are able to come at it more intelligently, not just to balance them out, but to say, what are the ways we can achieve the goals, all of the goals here better? Let's optimize working capital, and at the same time, make sure we have enough inventory to support upside opportunities. Successful companies also do a very good job in their relationships and their contracts, making them flexible. They got great visibility across their chain. They're going to integrate risk management into their inventory strategy. And as we mentioned, making sure that you've got your day-to-day operations, your day-to-day metrics and incentives all aligned with your strategic goals. And so this is my story of the holistic strategy, and I think hopefully you've learned something good today, and I'd like to open it up for questions.
All right, thanks so much, Bill. Great stuff there, and yeah, as Bill said, we would very much like to hear from you now. You can enter your questions in the Q&A block that you should see to the right of the slides. So please do enter your questions now. Bill, we have a question here. You talked about reading the mind of the consumer. Can you say more about what that means and what people are actually doing?
Okay, that's a great question. So I think there have been some recent developments, and I talk about, it's not just about inventory issues. It's also about pricing. But some of the challenge that in particular, say, retailers have is, say, unfulfilled demand. So you've got somebody walks into a store and they don't find what they want, so they walk out. That is not captured by any system for most retailers. They don't know that they could have sold one if they had it in stock or if they had a different mix. So one of the things that some companies are doing is starting to monitor the Wi-Fi traffic in stores and see what are people searching for. And that's again, none of these are panaceas, but they all can help in aggregate. So now you would see that, hey, a lot of people are searching for black jeans. I'm only keeping other colors. Maybe I should be stocking black. So that would be one example. The other example I already mentioned was this sort of games for setting prices. And I think that we're starting to see actually some major retailers use, and CPG companies, and especially fashion-based companies, to use those kind of tools to, the traditional tools might be a focus group. This is a way to get to a much broader audience and in a more scientific way to understand what they want. So that way you're much more likely to be on target, not get stuck with extra that nobody wants or not enough of the hot item. And so, yeah, I'd say those are a couple of the ways that come to mind.
All right, great. So again, if you have questions about your supply chain, your inventory management pain points, Bill is a great resource here to ask for the next few minutes. Bill, another question. Why would you say a cloud-based WMS would be good for providing supply chain-wide inventory visibility? Okay, so it's not the only way to get visibility across the supply chain, but it is an attractive option here. So first of all, these cloud-based systems tend to have been set up to be more integrative. So it's not necessarily that a non-cloud-based system can't do the same thing, because some of them have very good integration capabilities. But can you pull in the data from other systems like your transportation system and your procurement system and maybe third-party systems all into one source? That would be sort of the first question about these, and one reason that cloud tends to have the advantage. But I think also, more to the point, let's just talk about WMS in general as the visibility point for this end-to-end inventory. WMS systems are set up to keep very granular data about inventory and about the location of inventory. So they're already good at tracking inventory, and when they get extended, as some of these cloud vendors have done, to track inventory in the stores as well as the DCs and inventory in transit, then they become a good option to provide that foundational data. Now, you're still going to need other tools on top of that to accomplish the various things that you want to accomplish, whether it's inventory optimization or whether it's order promising or things like that. But this provides that visibility foundation, if you will. All right. Another question. We're a small company. How can we afford the kind of technology you talked about? Well, that's a great question, and I think, first of all, it depends on what you mean by small, right? A $10 million manufacturer would be different than a $500 million, and both might consider themselves small compared to a multi-billion-dollar company. But besides the size question,
a lot of time the issue is, of course, it's cost, but it's also your internal resources. You don't have an IT group, or you may have a very stretched and very small IT group, depending on the size of your company. And I think this is where, of course, you're going to want to be selective and figure out what technology is really important for your business at this time. I think that goes without saying. But also, one of the things we've seen with the advent, not just of, well, I would say of software as a service is a great boon, because now you can start to deploy this software without having to deploy your own data center and all of the things that go along with managing the machines, the infrastructure, the network, and the upgrades to the software and the patches, and all of that stuff can be done by a third party. So that's one part of the answer. And I think the other is, we've seen this trend towards, there's a big battle over the mid-market and small and medium enterprises. And so we've seen that a lot of companies are doing a lot to make their software a lot easier to get up and running, and sort of easier to use and easier to manage for the small and medium companies. So if you looked at technology, say, even 5 years ago, it's worth taking another look, because there's price pressure on vendors. And I'm not saying that from your perspective it's going to look cheap, but prices are coming down, and you have these options of software as a service, and also systems that are templatized and set up to be pretty easy to get up and running quickly.
All right. We are probably about ready to wrap up here, unless there are any other questions. So Bill Macbeth of Chainlink Research, thanks so much for joining us today. A really informative and useful session with some great recommendations. On behalf of all of our audience, I want to say thanks for your time. And again, Bill's contact information is on the slide as well.
Yeah, and feel free to contact me if you've got any further questions or anything you'd like to talk about. We're researchers. We love talking to people and finding out what you're doing and what your issues are, and so forth. So it's a pleasure being here. Thanks, Jason.
All right, great. So we're going to end the formal part of the session here and stop the recording.